The future of investing will belong to those who understand cycles, economic, technological, and geopolitical. It's not about guessing the future, but recognizing patterns that have repeated for centuries. Most people believe the world is changing in ways it never has before. But when you study history carefully, you find that while the tools and technologies evolve, human nature remains the same. Greed, fear, ambition, and the pursuit of power, these are constants because people don't change much. The cycles that drive markets, nations, and empires also don't change much. They may take new forms, but the underlying dynamics repeat. Understanding these repeating patterns is one of the most powerful edges an investor can have. The economy functions like a machine. Every transaction is an interaction between a buyer and a seller, driven by the exchange of credit or money for goods and services. These transactions add up to cycles, periods of expansion and contraction that have existed for as long as markets have existed. When credit is easy to obtain, spending increases, productivity rises, optimism spreads, and asset prices climb. But when debt levels become too high, spending slows, defaults begin, and the cycle reverses. Central banks step in, lower interest rates, and stimulate the economy again, starting a new wave of growth. These are the short-term business cycles, typically lasting around 5 to 10 years. But there's also a much bigger cycle underneath it, the long-term debt cycle, which can last half a century or more. Over decades, as debt grows faster than income, countries reach a point where they can no longer service that debt easily. They respond by printing money, inflating away their liabilities, and eventually devaluing their currency. You can see this pattern throughout history. The collapse of the British pound as the global reserve currency after World War II, the end of the gold standard in the 1970s, and the modern era of quantitative easing after 2008. The details differ, but the essence remains the same. Debt accumulates, policymakers print, currencies weaken, and wealth shifts. Recognizing where we are in these cycles is critical. In 2025, we are not at the beginning of a new credit expansion. We are late in a long-term cycle where debt, money creation, and asset valuations are all elevated. That means the traditional playbook, simply buying and holding assets without regard to valuation or risk, may not work as well going forward. Investors who understand this will look beyond short-term market moves and focus on structural realities, demographics, productivity trends, fiscal sustainability, and the global balance of power. When you study economic history deeply, you see that every major boom was followed by a bust, every debt buildup by a deleveraging, every monetary expansion by a contraction, and every dominant empire by a decline. The Dutch, the British, and now the American empire all followed similar arcs, rising through innovation, education, and productivity, peaking with global trade dominance, and declining under the weight of debt, inequality, and geopolitical overreach. That doesn't mean America is collapsing. It means it's transitioning to a new phase of the long-term cycle where competition among global powers intensifies and monetary policy becomes a key tool of adjustment. In this environment, investors needed to think differently, instead of asking, what will the market do next quarter? The right question is, where are we in the cycle, and what are the forces that will likely drive the next decade? Those who can answer that question intelligently position themselves ahead of change instead of reacting to it. The key is to see the patterns beneath the noise. For instance, technological cycles move alongside economic ones. Every few decades, a transformative technology reshapes productivity, jobs, and capital allocation. The steam engine, electricity, the internet, and now artificial intelligence all have followed predictable diffusion curves. In the early stages, innovation is underestimated. In the middle, overhyped. and in the mature phase, consolidated by dominant players. Understanding where we are in the technology adoption curve helps investors identify sustainable opportunities rather than short-lived fads. In 2025, AI and automation are still in the acceleration phase. Massive potential remains, but valuations and expectations are already inflated in some sectors. The wise investor balances exposure to innovation with caution against speculative bubbles. Geopolitical cycles also play a defining role. Power always shifts between nations as their internal conditions change. When one country accumulates too much debt, loses productivity, or becomes divided internally, its global influence weakens. Another nation, usually with rising productivity and unity, steps up. This pattern has played out repeatedly, from the Dutch to the British to the Americans, and now potentially toward a more multipolar world involving China, India, and other emerging economies. For investors, this means global diversification isn't optional anymore. It's essential. The 21st century will not be dominated by one economy, but by several, each driving growth in different regions and industries. To invest wisely, you must think like a macro historian and a scientist at once. You must observe how systems behave, how imbalances build, and how they correct. You must study interest rates, productivity trends, debt levels, and policy responses, not to predict the next crisis, but to prepare for it. Because cycles are inevitable, the real power lies not in timing them perfectly, but in building resilience. That's what allows you to survive downturns and capitalize on upswings. One of the greatest mistakes investors make is assuming the recent past will continue indefinitely. They see markets rising and believe it's permanent, or they see a crash and assume the world is ending. Both are emotional reactions, not analytical insights. The truth is, cycles always turn. What goes up too fast eventually cools down. What falls too far eventually rebounds. The challenge is to detach from short-term sentiment and focus on structural realities. For example, if you knew in 2007 that global debt levels were unsustainable and housing prices were far above income growth, you could have seen the cracks forming before the 2008 crisis. Similarly, if you understand today that governments worldwide are running record fiscal deficits while central banks attempt to tighten policy, you can anticipate that volatility and structural shifts are inevitable in the coming years. These aren't surprises, they're the natural outcomes of where we are in the cycle. Understanding cycles also builds humility. It teaches that nothing lasts forever. Not booms, not recessions, not even empires. It reminds us that the best investors don't rely on confidence, they rely on balance. They accept that they will sometimes be wrong and prepare for multiple outcomes instead of betting on one. This mindset, what I call a radical humility, is one of the greatest assets you can possess. It keeps you grounded, rational, and adaptive in a world driven by uncertainty. So when you think about investing in 2025 and beyond, don't focus on predicting the next headline or market move. Focus on understanding the timeless patterns that have always governed economies and human behavior. Study history deeply. Observe credit creation, policy shifts, and technological disruptions. Recognize that cycles are like seasons. They may vary in length or intensity, but they always come. The key is to prepare your portfolio like a farmer prepares his land, planting diverse crops, protecting against storms, and harvesting patiently when conditions are right. Because in the end, the investors who thrive are not those who can predict the future. They are the ones who understand the patterns of the past and position themselves wisely for what's coming next. The world will continue to change, but the rhythm of cycles will not. And those who learn to move in harmony with those cycles rather than fighting them will build lasting wealth through every season that lies ahead. Diversification is not just a strategy, it's a principle of nature. If you look at how the world sustains balance, you'll find that everything, from ecosystems to economies, survives because of diversification. A forest thrives because it doesn't depend on one species. The weather system functions because of the interaction of multiple forces. Your body maintains health through the balance of different organs and systems working together. Nature shows us again and again that concentration leads to fragility and diversification leads to resilience. The same principle applies to investing. Most people think diversification simply means owning multiple assets. But true diversification runs deeper. It's about owning a variety of assets that perform differently under different conditions. The biggest misconception investors hold is believing that owning many things automatically reduces risk. It doesn't if those things move in the same direction for the same reasons. Real diversification is achieved when the risks are uncorrelated, when the failure of one investment is offset by the success of another. That's what creates stability, and it's one of the few free lunches in investing. In the financial world, everything is connected through cycles. Stocks, bonds, commodities, currencies all react to changes in growth and inflation in predictable ways. When growth is strong and inflation is low, equities tend to perform well because profits are rising and borrowing costs are manageable. But when inflation increases or growth slows, those same equities may fall. In contrast, assets like commodities or inflation-linked bonds may rise during inflationary periods. By holding a mix of assets that respond differently to the same conditions, you create a portfolio that is less sensitive to any one outcome. When I built the all-weather portfolio, the goal was not to maximize returns. It was to balance risk so that no single economic environment could destroy the portfolio. The idea was simple: divide the world into four possible conditions: rising growth, rising inflation, and falling inflation. Every asset performs well in one of these four. Stocks thrive in rising growth. Long-term bonds thrive in falling growth. Commodities and gold perform in rising inflation, and cash or short-term bonds preserve value in falling inflation. By allocating across all four environments, the portfolio remains stable no matter what happens. That's the power of balance. But diversification isn't just about asset classes. It's also about geography, currency, and even time. Think about it. When all your investments are tied to one country, one currency, or one market, you're exposed to that system's unique vulnerabilities. If that nation faces political instability, inflation, or a currency crisis, your entire portfolio could suffer. History has shown that every empire and every economy eventually faces its own challenges. No single system dominates forever. So just as you wouldn't plant all your crops in one field, you shouldn't anchor all your investments in one region. Spreading across geographies, developed and emerging markets, protects you from local shocks and gives you exposure to global growth. Time diversification is another dimension people rarely consider. The markets are driven by short-term noise, but wealth is built through long-term consistency. Trying to time the market, jumping in and out based on emotion or prediction, is one of the fastest ways to destroy returns. Instead, spreading investments across time by investing regularly and rebalancing periodically smooths out volatility and compounds growth. It's a way of saying, I don't know what will happen tomorrow, but I'm prepared for whatever comes. Another important element is diversifying risk exposure, not just capital allocation. Most investors allocate more money to what feels familiar or comfortable, like stocks. But that often means most of their risk comes from one source: equity risk. If the stock market falls, the entire portfolio suffers. Instead, investors should balance the risk contribution of each asset so no single one dominates. This concept, called risk parity, ensures that each component of the portfolio contributes equally to its overall volatility. It's a more sophisticated way to achieve real balance. But let's step back and think about why diversification works. It works because the world is uncertain and because human beings are biased. We overestimate our ability to predict and underestimate the range of possible outcomes. Diversification protects us from our own ignorance. It acknowledges that we don't know which investments will perform best, and that even the smartest investors can be wrong. By owning uncorrelated assets, you create a structure that allows your portfolio to survive your mistakes. It's not an admission of weakness. It's a recognition of reality. Look at the greatest financial collapses in history, and you'll find that a lack of diversification played a central role. In 2008, portfolios heavily concentrated in housing or banking stocks were wiped out. In 2000, those overloaded with technology stocks suffered massive losses. In 1998, hedge funds that bet too heavily on a single trade, like long-term capital management, collapsed despite having Nobel laureates behind them. The common denominator was concentration. The lesson is timeless, no matter how certain you feel. Never bet everything on one outcome. Because in markets, the things you don't expect are often the things that matter most. Diversification doesn't eliminate risk. It transforms it. It takes concentrated, unpredictable risks and spreads them into manageable, predictable ones. Instead of large losses from a single source, you experience smaller fluctuations from many. This makes the compounding process smoother, which is critical. Remember, a 50% loss requires a 100% gain to recover. Avoiding big drawdowns is more important than chasing big returns. Diversification helps you do that by creating a portfolio that can bend but not break. However, diversification is not static. It must evolve as the world changes. The assets that once offered diversification may not always do so. For instance, in the past, stocks and bonds often moved in opposite directions. But when both inflation and interest rates rise, they can fall together. That's why continuous learning and adjustment are vital. You must always question your assumptions, test correlations, and adapt your strategy as conditions shift. What worked in the last decade may not work in the next. Psychologically, diversification also protects you from emotional extremes. When one part of your portfolio is underperforming, another is likely doing well. This balance keeps you grounded, preventing panic selling during downturns and overconfidence during rallies. It allows you to think clearly and act rationally, two traits that are rare when fear and greed dominate the market. Beyond markets, diversification is a principle that applies to life itself. Just as an investor shouldn't rely on one asset, a person shouldn't rely on one income stream, one skill, or one opportunity. Building multiple sources of income, developing new abilities, and maintaining relationships across different fields all contribute to personal resilience. In an uncertain world, diversity of assets, of knowledge, of perspective is your greatest safeguard. So when you build your portfolio for 2025 and beyond, don't aim for perfection, aim for balance. Spread your bets intelligently across different economies, asset classes, and time horizons. Think in terms of probabilities, not certainties. The world will always surprise you, but if your foundation is diversified, those surprises won't break you. They'll simply test your preparation. Remember that the goal isn't to avoid loss entirely. It's to ensure that no single loss can take you out of the game. Because the investor who stays in the game long enough, compounding wisely, will always outperform the one who tried to be right all the time but couldn't survive being wrong once. Nature has taught this truth over millions of years. Resilience beats perfection, adaptability beats prediction, and balance sustains life. The same is true in investing. Diversification is not merely a tactic, it's a reflection of how the universe itself survives chaos. If you align your portfolio with that universal principle, you'll not only protect your wealth, you'll give it the freedom to grow steadily through every storm, across every cycle, and beyond every uncertainty the future brings. The biggest risk investors face is themselves, emotional decisions driven by fear and greed. No external force destroys wealth as efficiently as the human mind under pressure. The markets are reflections of human behavior, and since human nature rarely changes, the same psychological mistakes repeat generation after generation. Understanding this truth is essential to becoming a successful investor. The economy may change, technology may evolve, and governments may shift policy, but the emotional cycles of greed, euphoria, panic, and despair remain constant. Those who learn to manage their emotions, rather than be ruled by them, achieve consistency in a world that thrives on chaos. When you look back at major financial events, from the Great Depression to the dot-com bubble, the housing crisis, or even the more recent volatility caused by pandemic shocks, the core driver behind them all was human emotion amplified by leverage. In every case, optimism became euphoria, euphoria turned into overconfidence, and overconfidence into recklessness. Then, when reality broke the illusion, panic set in. People sold what they should have held and bought what they should have avoided. The same cycle repeats every few years because people forget the pain of the last downturn during the pleasure of the next boom. In the short run, markets are voting machines. As Benjamin Graham said, they reflect popular opinion. In the long run, they are weighing machines. They reflect a reality. But most people can't wait for the long run. They get caught in the noise of the present, reacting emotionally to every price move, headline, or rumor. They see prices rise and assume the trend will last forever. They see them fall and believe it's the end of the world. These emotional swings make people act irrationally, abandoning logic and discipline. Fear and greed are the invisible hands that move markets more powerfully than any central bank. Greed is the desire to make fast money. It's what drives bubbles, speculation, and blind optimism. It convinces investors that they've found a shortcut to wealth. It whispers that this time is different. During bull markets, people forget about risk. They stop asking hard questions because everything seems to be working. They see others getting rich and fear missing out. They mistake rising prices for intelligence. But the truth is, when everyone around you believes there's no risk left, that's when risk is highest. History proves it repeatedly. The late stages of every boom are defined by collective overconfidence. Fear, on the other hand, is the mirror image of greed. It arises when prices fall, when the same people who were once euphoric start to panic. They forget long-term fundamentals and focus only on short-term losses. They sell their strongest assets to feel safe, locking in losses and missing the eventual recovery. Fear blinds people to opportunity. It drives them toward cash at precisely the time when cash is losing value to inflation or when assets are on sale. The same emotional patterns that fuel booms also deepen busts. The irony is that markets tend to punish the majority precisely because the majority acts emotionally at the same time. The first step in mastering the emotional side of investing is self-awareness. You have to recognize your biases and understand how your brain responds to uncertainty. Humans evolved to survive in a dangerous world, not to thrive in complex financial systems. We are wired to seek safety when threatened and chase reward when tempted. In investing, this wiring works against us. Our instincts tell us to sell when we should hold and buy when we should wait. Successful investors learn to reprogram these instincts to act against emotion when necessary and to make decisions based on evidence, not impulses. One of the most powerful tools to overcome emotion is process. Having a clear, tested investment framework, one that defines when to buy, sell, or rebalance, removes guesswork, and reduces emotional influence. When you have principles that guide you, you rely less on mood and more on logic. For example, if your rule says to rebalance when an asset deviates 20% from its target weight, you'll buy low and sell high automatically, even if it feels uncomfortable. Discipline, not prediction, becomes your edge. Another important step is to think in probabilities instead of certainties. The future is never guaranteed, and no one knows exactly what will happen. Investors who expect certainty get anxious when the world surprises them. Those who think in probabilities accept uncertainty as normal. They don't need to be right all the time. They just need to prepare for a range of outcomes. This mindset creates calm in a chaotic market. It turns emotion into strategy. Humility also plays a major role in emotional control. The moment you believe you can't be wrong is the moment you're most vulnerable. The greatest investors in history, from Warren Buffett to George Soros, are not successful because they're always right. They're successful because they know how to manage being wrong. They cut losses quickly, learn from mistakes, and never let ego dictate decisions. Ego is the hidden enemy of rational investing. It turns markets into personal battles instead of systems of probabilities. The more attached you are to your opinions, the harder it is to see the truth. Meditation, journaling, and reflection are tools I personally use to manage emotion. They slow down thinking, allowing reason to override reaction. When the market moves sharply, I pause before acting. I ask, is this decision based on logic or fear? Am I reacting to data or to my emotions? Most of the time, just asking that question reveals the answer. The best decisions are made calmly, not urgently. Markets reward patience far more than speed. Another concept to internalize is pain plus reflection equals progress. Emotional pain in investing is inevitable. You will make mistakes, suffer losses, and experience doubt. But if you reflect on those experiences honestly, you grow wiser. You begin to understand your own psychology. What triggers your fear? What feeds your greed? What biases cloud your vision? Over time, this self-knowledge becomes your competitive advantage. It allows you to act rationally while others are reacting emotionally. In a world driven by crowd psychology, that difference is enormous. If you study the greatest investors, you'll find they share one trait above all others: emotional stability. They don't get euphoric during rallies or despairing during crashes. They remain balanced, anchored by principles rather than emotions. When everyone else is panicking, they're buying. When everyone is greedy, they're cautious. This is not luck, it's discipline built through years of understanding themselves. The market rewards such balance because it is rare. In the end, mastering yourself is far more important than mastering the market. You can't control interest rates, inflation, or politics, but you can control how you respond. You can train yourself to detach from noise, to analyze clearly, and to make decisions grounded in probability, not emotion. This inner control is what separates the consistent from the chaotic. Building wealth, therefore, is not just a financial journey, it's a psychological one. It's about overcoming your instincts, developing patience, and thinking in decades instead of days. If you can manage your emotions through both euphoria and despair, you'll stay invested long enough for compounding to do its magic. You'll see what others miss and act when others freeze. The irony of markets is that the people who appear most calm during chaos are usually the ones who profit most from it. The greatest danger isn't that the market will crash or that inflation will rise. The greatest danger is that you will make an emotional decision that locks in loss or misses opportunity. If you can conquer that inner battle, no external volatility can truly harm you. The markets will always fluctuate, but your response doesn't have to. And when you reach that level of composure, when emotion no longer dictates your choices, you will have achieved what very few investors ever do. Mastery over yourself, which is the ultimate form of wealth. The new era of wealth building will reward adaptability. The world is changing faster than most people can comprehend, and the greatest risk in this environment is not uncertainty. It's rigidity. Those who cling to old assumptions about how money, markets, and economies work will find themselves falling behind, while those who understand how to evolve will rise. The global system we are entering now is different from the one most investors grew up in. Debt levels are at record highs. Technological revolutions are accelerating. Demographic trends are shifting. And geopolitical tensions are redefining global trade and capital flow. To build wealth in this kind of world, you must understand how money, credit, and productivity interact, and how to shift between assets, industries, and strategies as the environment changes. The first principle of adaptability is to recognize that everything moves in cycles, but at different speeds. Productivity grows steadily over time as innovation improves efficiency. Debt and credit cycles move more quickly, expanding and contracting over decades. Political and social cycles rise and fall over generations. If you only focus on one of these, you'll miss the broader context. Wealth builders must see how these forces combine. For instance, a rising debt burden may inflate asset prices temporarily, but without productivity growth, it's unsustainable. Likewise, a technological boom may create enormous value, but if it outpaces regulatory or social adaptation, it creates bubbles. Understanding how these forces align or conflict determines where true opportunity lies. In the 2020s and beyond, we are living through the intersection of multiple major transitions. The long-term debt cycle is in its late stage, meaning central banks are increasingly forced to choose between inflation and stagnation. The geopolitical order is shifting from a unipolar to a multipolar world, with the US, China, India, and other regional powers competing economically and technologically. Meanwhile, artificial intelligence, automation, and renewable energy are reshaping the foundations of productivity and employment. These transitions are not isolated, they're interconnected. When debt, technology, and geopolitics move simultaneously, the world changes faster than conventional wisdom can keep up with. That's why adaptability, both mental and financial, is the defining skill of this new era. To be adaptable, you must first let go of the illusion of certainty. The old models of static allocation and predictable returns no longer apply. In the past, investors could hold a traditional 60 or 40 portfolio, 60% stocks, 40% bonds, and expect stable growth. That worked when inflation was low, interest rates were falling, and globalization kept costs down. But now, inflationary pressures are higher, supply chains are regionalizing, and debt-fueled growth is less effective. Bonds no longer provide the same diversification they once did, and equities are more correlated to global policy shifts. The environment has changed, which means the rules of portfolio construction must evolve with it. Adaptability also means understanding where value is shifting. For much of the 20th century, capital was scarce and labor was abundant. Now, the opposite is becoming true. Capital is abundant due to money creation, but skilled labor and innovation are scarce. That means the highest returns will go to those who allocate capital efficiently toward productivity, not speculation. Investments that create real output, like technology that improves efficiency, infrastructure that supports growth, and education that enhances human capital, will outperform financial engineering and short-term trading. The focus must move from leverage to value creation. The same applies at the individual level. In this new world, the ability to adapt your skills is as important as the ability to diversify your investments. The nature of work is changing rapidly. Jobs that once provided security are being automated, while entirely new industries are emerging. Those who invest in continuous learning, acquiring skills in technology, economics, and global systems will be far better equipped to thrive. Knowledge itself has become a form of capital, and adaptability of the mind is the new compounding asset. Understanding money and credit is also fundamental to adaptability. Money is simply a medium of exchange. It holds no intrinsic value. What gives it power is trust and productivity. Credit, on the other hand, is the engine that amplifies both growth and risk. When credit expands faster than income, economies appear to grow, but they are borrowing from the future. When that expansion slows or reverses, defaults rise and liquidity dries up. In this new era, as governments continue to finance deficits with printed money, investors must anticipate the long-term erosion of purchasing power. That means holding assets that cannot be easily debased. Productive businesses, tangible commodities, or real estate in stable regions. It also means being flexible enough to shift between cash, hard assets, and innovation-based investments depending on where we are in the cycle. Adaptability also means recognizing when the system itself is evolving. Over the next decade, we may witness the rise of new forms of money, digital currencies, blockchain-based assets, or central bank digital systems. Whether you choose to invest directly or not, you must understand how these innovations affect liquidity, regulation, and global capital flow. Every major transition in financial history, from gold to paper money, from fixed exchange rates to floating ones, from analog banking to digital finance, has created both immense risk and immense opportunity. The winners were not the ones who resisted change, but the ones who studied it early and adjusted. The same principle applies to geopolitics. As power becomes more distributed across nations, global trade and investment patterns will diversify. Supply chains will shorten. Regional alliances will deepen, and new growth centers will emerge in Asia, Africa, and Latin America. Investors who remain confined to traditional Western markets will miss a significant portion of global growth. Adaptability means expanding perspective, seeing the world as a network of interconnected economies rather than a single dominant system. The rise of a multipolar world may create short-term volatility, but it also creates long-term balance. For those willing to learn and diversify globally, this is an extraordinary opportunity. Another dimension of adaptability is emotional flexibility. When conditions change, many people freeze. They cling to what once worked, hoping it will work again. This happens to investors, businesses, and even nations. But the market doesn't reward nostalgia, it rewards awareness. When something stops working, the best question you can ask is, why? And what's next? That kind of curiosity is the foundation of resilience. In contrast, denial is the root of collapse. The ability to confront uncomfortable truths and make timely adjustments determines long-term survival, not just in finance, but in life. Adaptability also requires balance between conviction and openness. You must have principles that anchor your decisions, but not so rigidly that you can't evolve them when the data changes. This balance, staying true to timeless fundamentals while being flexible with tactics, is the hallmark of great investors. Principles give you direction, adaptability gives you maneuverability. Without both, you drift or crash. In the years ahead, As volatility becomes the norm and certainty becomes scarce, adaptability will become the ultimate form of intelligence. Those who understand systems thinking, how debt, productivity, technology, and geopolitics interact, will be able to navigate complexity calmly while others react emotionally. They won't try to predict every event. They'll prepare for multiple possibilities. They'll know when to hold risk, when to reduce it, when to shift from growth to safety, and when to pivot toward opportunity. Ultimately, building wealth in 2025 and beyond will not depend on luck, predictions, or perfect timing. It will depend on your capacity to adapt. The global economy is like an ocean, constantly changing tides. You cannot control the waves, but you can adjust your sails. The investors who thrive will be those who understand the wind, who remain flexible yet disciplined, and who build portfolios and mindsets that can weather any storm. Because in the new era of wealth, success will not go to the strongest or the smartest. It will go to the most adaptable. When you step back and look at everything we've discussed, you begin to see a pattern that has repeated itself throughout history. Every great financial era, every cycle of prosperity and collapse, every technological and societal shift has followed the same rhythm: progress, excess correction, adaptation, and renewal. We are once again standing at that point of transition. The old rules that governed wealth for decades are being rewritten in real time. The world of 2025 and beyond will not reward those who cling to what used to work. It will reward those who understand how the system works now and how to adapt as it continues to evolve. We are entering an age where money, technology, and global order are all transforming simultaneously. The debt cycle is maturing, inflation is reemerging. Central banks are experimenting with new forms of money, and technology, particularly artificial intelligence, is redefining productivity and labor itself. In such times, there is no safe play. In the traditional sense, safety will come not from hiding, but from understanding. The more you understand the mechanics of the economy, how credit expands, how productivity drives real growth, how cycles create opportunity, the more confident and rational your decisions will become. Knowledge, not prediction, is your greatest edge. Building wealth in this new world is not about gambling on what comes next. It's about structuring yourself to thrive no matter what comes next. That means diversifying intelligently across assets, geographies, and even ideas. It means owning things that hold real value, productive businesses, hard assets, and skills that compound over time. It means maintaining a balance between offense and defense, between risk-taking and protection. In essence, it's about building your own all-weather approach, one that can endure inflation, deflation, prosperity, and crisis alike. But wealth is not just a financial concept, it's also mental and emotional. If your understanding of the system grows faster than the system itself changes, you will remain ahead. But if you cling to fixed ideas while the world evolves, your decisions will always lag reality. That's why adaptability is not just a tactic, it's a philosophy. The willingness to question, to learn. We have knew all those orders. To evolve your principles while staying anchored to truth is what separates those who merely survive from those who prosper. In uncertain times, people often look for gurus predictions or shortcuts. But the truth is, no one, not even the greatest investors, can predict the future with precision. What they can do, however, is build principles that work across time. That's what I've tried to do in my life and what I urge you to do in yours. Don't chase outcomes, study causes, don't react to markets, understand their cycles. Don't seek comfort, seek clarity. When you think in terms of systems rather than moments, the noise fades and the path becomes visible. The next decade will test our understanding of value, patience, and resilience. Many will be distracted by volatility, headlines, and fear. But those who focus on fundamentals, on productivity, diversification, and adaptability will emerge stronger. Remember that wealth is built not in the moments of euphoria or panic, but in the moments of discipline. It's built quietly through consistent learning, rational decision-making, and staying true to timeless principles even as the world changes. As we look ahead, ask yourself, are you preparing for the world you want, or are you still investing in the world that was? Because the difference between the two will define your future. The systems that once sustained prosperity are shifting, and new opportunities are being born out of that shift. Those who stay flexible, curious, and humble, who treat investing as a lifelong education rather than a short-term race, will not only preserve wealth, but multiply it. In the end, all success, financial or otherwise, comes from alignment between reality and behavior, between principles and action, between what you know and what you do. The markets will always move through cycles. Governments will change policies. Technologies will disrupt industries, and societies will evolve. You can't control any of that. But you can control how you perceive, how you prepare, and how you respond. And that is where your real power lies. So as you step into 2025 and beyond, don't just look for the next hot investment or trend. Look for understanding, build your principles, study history, diversify widely, think globally, stay humble in the face of complexity, and confident in your ability to learn. Because in a world of constant change, the greatest investment you can make is in expanding your own adaptability and awareness. Wealth, after all, is not a destination. It's the byproduct of thinking clearly, acting rationally, and evolving continuously in harmony with reality. And that is how you build wealth, not just for 2025, but